Separating lines is a candlestick pattern that indicates the continuation of a trend in technical analysis. This pattern consists of two candlesticks. The first is a long candlestick that follows the direction of the current trend, and the second is a long candlestick of the opposite color that opens at the same price as the first but does not reverse the trend. Basically, if the trend is upwards, the first candlestick would be green, indicating a price increase, and the second would be red, opening at the same level as the first, but closing without changing the overall direction of the market. This suggests that despite the temporary pullback represented by the second candlestick, the existing trend is likely to continue. Variations and similar patterns fall within this realm, offering signals with different structures but conveying a similar message of trend continuation. Some of these include on neckline pattern. This involves a long bearish candle followed by a smaller bullish candle that closes near the low of the previous bearish candle. It is typically seen in downtrends and suggests that the downward trend will continue. In neckline pattern. Similar to the on neckline pattern, but the second candle closes slightly into the body of the first candle. It also indicates a continuation of a downtrend. Thrusting line pattern. In a downtrend, a long bearish candle is followed by a bullish candle that opens lower but closes within, but not above, the midpoint of the body of the first candle. This pattern suggests that sellers are still in control, and the downtrend is likely to persist. Meeting lines pattern occurs in a downtrend where a long bearish candle is followed by a long bullish candle. What differentiates this from the separating lines is the second candle closes at or around the same price as the opening of the first candle, signifying potential trend reversal or continuation. Understanding the nuances between these patterns can significantly enhance a trader's ability to interpret market signals accurately. Recognizing not only the difference in structure, but also the implications of each variation allows for a more nuanced market analysis and potentially more informed decision-making. By distinguishing between these closely related patterns, traders can refine their predictions on market movements and better strategize their trades. Trend reversal patterns play a critical role in the world of trading and investing by identifying significant shifts in market sentiment. These patterns indicate potential changes in the direction of prices, offering traders and investors an opportunity to adjust their strategies accordingly. One pivotal indicator of such shifts is known as the breakaway pattern. The breakaway pattern often signifies the start of a new trend, marking a potential change in the balance between buyers and sellers. It is characterized by a series of specific candlestick formations that suggest a movement away from a previous price range and the beginning of a new market direction. The introduction to the breakaway pattern begins with the observation of a trading range where prices have been relatively stable. The pattern emerges with a strong price movement, which is typically accompanied by increased volume, signaling a break from the prevailing trend. The initial movement is followed by a few days of consolidation, which may include slight movements in the opposite direction, but not enough to return to the original trading range. This phase is crucial as it represents the market's hesitation before fully committing to the new trend. Finally, another strong move in the direction of the new trend confirms the breakaway pattern, indicating that the market sentiment has shifted and a new trend has been established. Understanding the breakaway pattern helps traders and investors anticipate future price movements by interpreting these early signs of trend reversal. By recognizing the formation of such patterns, they can make more informed decisions about entering or exiting positions in anticipation of a major trend change, potentially leading to profitable trading opportunities. The breakaway pattern is a key concept in understanding shifts in market trends, which can occur in both upward, bullish, and downward, bearish directions. It is characterized by a specific formation that involves 5 candles on a price chart. This pattern starts with the first candle that aligns with the ongoing trend. What follows is a significant gap, which is a space where no trades occur, leading to a disconnect between this candle and the next. After the gap, there are 3 additional candles that begin to move in the opposite direction of the initial trend, indicating a potential reversal. The 5th and final candle in this pattern works to close the gap that was created earlier. This sequence of candles suggests a strong shift in market dynamics. Initially, the gap may represent a moment of hesitation or a sudden, strong response from the market that moves away from the prevailing trend. The subsequent candles moving oppositely to the trend highlight the growing momentum in this new direction. By the time the gap is closed, it is often interpreted that the market sentiment has substantially shifted, setting the stage for a new trend to begin. Understanding the breakaway pattern provides investors with valuable insights into potential points of market reversal. It highlights not just the change in price, but also the change in momentum and market sentiment, which are crucial for making informed trading decisions. The breakaway pattern in financial markets is indicative of a significant change in market sentiment. When we observe a breakaway pattern, it is characterized by a gap on the chart. This gap acts as a visual marker, illustrating that there has been a sudden and decisive shift in trader attitudes towards the asset in question. Essentially, this shift suggests that the momentum has now firmly moved in favor of the new trend's direction. To understand this better, consider the gap as a lack of trading activity within a certain price range. This happens because traders collectively agree that the asset is either undervalued or overvalued at its current price, leading to a rapid adjustment in price to reflect this new consensus. This swift move signals a break from previous price patterns and indicates that traders are now aligning their positions with the anticipated new trend, thereby showcasing a solid momentum shift in the market. In conclusion, the breakaway pattern not only reflects a strong change in market sentiment, but also indicates that traders are making significant moves in anticipation of a new market trend, which can provide opportunities for strategic investments. The breakaway pattern is critical for traders and investors to understand because it serves as a key indicator of a trend reversal, marking the transition from an old trend to the start of a new one. This concept falls under the broader category of technical analysis, which traders use to forecast future market behavior based on past and current price movements. When we talk about the breakaway pattern, we are essentially referring to a situation where the price of an asset moves outside of a consolidation area or breaks through a significant support or resistance level with increased volume. This movement indicates a shift in market sentiment and suggests that the old trend has ended, making way for a new trend to begin. For example, in a downtrend, a breakaway pattern might occur when the price suddenly moves upwards, breaking past a resistance level that previously kept the price from rising. This signals that sellers are losing control and buyers are starting to dominate, potentially leading to a new uptrend. Understanding whether a pattern signifies continuation or reversal is crucial for traders. While some patterns may hint at the ongoing trend's continuation, the breakaway pattern is distinctly recognized as a precursor to a trend reversal. Recognizing this pattern allows traders to adjust their positions accordingly, potentially closing out positions that are likely to be negatively affected by the new trend or opening new positions to take advantage of the emerging trend. To spot a breakaway pattern, traders look for a significant gap in price movement accompanied by increased trading volume. This gap and volume serve as confirmation that a substantial shift in market dynamics is underway. Grasping the essence and implications of the breakaway pattern can greatly assist traders in making informed decisions, thereby aligning their strategies with the market's new direction. I'm sorry, but it seems there was a misunderstanding in your request. Could you please provide me with more specific details or clarify your question? The breakaway pattern signals the start of a new trend and is considered a strong indicator of potential market direction changes. However, its reliability is significantly enhanced when used alongside other analytical tools. These tools can include, but are not limited to, moving averages, volume analysis, and momentum indicators. The context in which the breakaway pattern forms is equally important in assessing its significance. For instance, a breakaway pattern that occurs after a prolonged period of consolidation might carry more weight than one that appears in a more volatile market environment. Additionally, the volume of trades during the formation of this pattern can provide valuable insight into its strength and potential longevity. A high volume suggests strong market interest and can confirm the pattern's reliability, whereas a low volume might indicate a lack of conviction among traders, making the pattern less trustworthy. It is always advisable to consider the broader market context and use a combination of tools when interpreting the breakaway pattern to make informed trading decisions. To integrate the breakaway pattern with other technical analysis tools for a comprehensive approach, one can utilize the Relative Strength Index, or RSI, alongside the Moving Average Convergence Divergence, known as MACD. The RSI helps to determine when an asset is in overbought or oversold conditions. For instance, before a breakaway pattern forms, the RSI might indicate an asset is oversold, suggesting that a reversal to the upside could be imminent. This condition sets the stage for a breakaway pattern. Once the breakaway pattern is identified, confirming the change in trend momentum becomes crucial. This is where the MACD comes into play. The MACD can validate the momentum shift suggested by the breakaway pattern through its moving averages and histogram. A change in the direction of the MACD line, especially when it crosses above or below the signal line, can confirm the trend's direction implied by the breakaway pattern. Combining these tools offers a more holistic view of the market's behavior. The RSI provides an early signal of potential reversal points, while the MACD offers confirmation of the trend's strength and direction following the breakaway pattern. This strategy harnesses the strengths of both indicators to make more informed investment decisions. When analyzing the breakaway pattern, which indicates the start of a new trend, it is crucial to avoid common mistakes to ensure accurate interpretation and decision-making. One prevalent error involves misidentifying the pattern without observing the proper gap. The gap is an essential component of the breakaway pattern, as it demonstrates a significant shift in investor sentiment and market dynamics. Confirming the presence of a gap helps distinguish a genuine breakaway from normal price fluctuations. Moreover, the importance of volume in validating the breakaway pattern cannot be overstated. An increase in trading volume during the formation of the pattern lends credibility to the emerging trend, signaling strong buying or selling interest that could propel the price further in the new direction. Ignoring volume indicators might lead to misinterpretation of the pattern's strength and reliability. Lastly, relying solely on the breakaway pattern without considering the broader market context is a common pitfall. Market trends, economic indicators, and other technical patterns should also be taken into account. This comprehensive analysis ensures that the breakaway pattern does not lead to hasty decisions based solely on its formation, but rather fits within a larger, more coherent investment strategy. Remember, accurate pattern recognition, coupled with a well-rounded analysis of market conditions, is key to leveraging the breakaway pattern effectively for investment decisions. To leverage the breakaway pattern effectively in trading, it is crucial to first understand this pattern indicates a potential start of a new trend. The breakaway pattern emerges from a chart formation, signaling significant changes in price movements, either upwards or downwards. To utilize this pattern, traders should look for a clear confirmation. One common approach is waiting for at least 5 candles after the pattern forms, which helps to confirm the strength and direction of the new trend. The 5th candle, especially if it closes the gap created by the breakaway, can be a strong indicator that the new trend has started. Entry points are optimally set soon after the pattern's confirmation. Traders often enter a position right after the 5th candle that confirms the trend to capitalize on the early stages of the momentum. When determining exit points or setting stop-loss orders, it is vital to consider subsequent resistance or support levels. These levels indicate where the price movement might stall or reverse, providing a strategic point for exiting the trade to maximize gains or minimize losses. Additionally, a predefined risk-reward ratio can be employed to make disciplined exit decisions. This ratio helps traders manage their risk by setting a targeted profit level that justifies the risk taken on the entry. In summary, leveraging the breakaway pattern involves waiting for confirmation after the pattern forms, setting strategic entry points soon after this confirmation, and using subsequent resistance or support levels along with a predefined risk-reward ratio to establish exit points. This approach allows traders to manage risk while capitalizing on the momentum of a new trend.